Hello, everybody. Thank you for attending today's Gifting and Estate Planning Strategies webinar. My name's Adam Etzel. I am a wealth advisor with JFS Wealth Advisors. And also, there will be a Q&A session at the end. So if you have any questions at all during the presentation, you can just put them in the Q&A box. I will do my best to answer them. But sometimes I might need more facts or information in order to be able to answer them accurately. So if you do ask a question, I may follow up with you afterwards just to make sure your question is answered. So today we are going to be discussing the 2025 gift tax rules, the role of gifting in estate planning, tax efficient giving strategies, understanding tax reporting or the Form 709, advanced gifting techniques, and considerations for high net worth families and business owners. Here are the gift tax rules for 2025. There is an annual gift exclusion. That amount is the amount that one person can give to another person or an entity such as a trust without having to file a Form 709. Basically, what that is the annual gift exclusion for 2025 is $19,000 per person to a recipient. Or if you are a married couple, you can essentially double that, and that gift could be $38,000. What happens if you give more than that? You certainly can. What you need to do is you need to file a gift tax return or Form 709. And what happens is your federal lifetime gift and estate tax exemption is reduced by the amount that is over the annual gift exclusion. So for example, if you gave $20,000 to a person, your federal lifetime gift and estate tax exemption would be reduced by $1,000. It does not necessarily mean that you have to pay any tax. It just means that there are some implications. The annual exclusion gifting is a powerful strategy to move wealth out of your estate and to do that over time. The lifetime gift and estate tax exemption changes every year. For 2025, this amount is $13.99 million per individual or $26 million per married couple. In 2026, it's expected to be about $15 million per person or $30 million for a married couple. These amounts are locked in unless Congress changes the law in the future. So just a little bit more about the lifetime gift and estate tax exemption. It is the amount that you are allowed to pass either through gifts above the annual gift exclusion or through your estate. So there becomes this question of what happens if the exemption was lower in the future. Gifts that are made while the exemption is higher are protected under the IRS no clawback rule. Lifetime gifts that are used at a higher exemption are not retroactively taxed if in the future the exemption would be lowered later. Future reductions affect what's left. A lower exemption in the future reduces how much you can still transfer tax-free, but it does not impact any gifts that were already completed. This is why acting early can lock in the benefit. Large gifts now remove both assets and all future growth from your estate and shelter them permanently from potential estate tax and maybe in the future, lower future exemptions. It's hard to say what Congress is going to do in the future, so it's good to be thinking about gifting. Spousal gifting, this is essentially for married couples. Married couples can elect to split gifts, treating one spouse's gift as coming equally from both. So for example, one spouse gives $38,000 to a child, they could be deemed to have gifted $19,000. So gift splitting requires both spouses to sign the 709 gift tax return. This strategy can help equalize estate sizes between spouses. It could also double the annual exclusion benefit. So if you're married, you get a little bit of a benefit where essentially the annual gift exclusion is doubled. Gifting and estate planning. So gifting isn't really just about taxes. What it is it's about control, it's about timing, and it's about legacy. It lets you move assets to your heirs while you're still alive, and you're ultimately able to see that impact. But it also does some other things for you as well. So lifetime gifts could help reduce your taxable estate, can shift future appreciation out of your estate. You can fund value-driven goals such as education or philanthropy. For most people, the lifetime gift and estate tax exclusion doesn't really affect most Americans. They're relatively high for most people. So lifetime gifting is something that could just help you get assets to the next generation. You can kind of see the impact, but you can also use giving as a way to influence your values, such as philanthropy or education. But when you align it with your estate plan, it also helps consistent documentation, it helps with beneficiary intent, and it also can help with tax strategy as well. For multi-generational planning, lifetime gifts can support multiple generations, your children, your grandchildren, or great-grandchildren. You can promote education, housing stability, such as buying a home or helping with the down payment on a home, or you could help start a business. Some people use irrevocable trusts as a lifetime gifting strategy and also a future planning strategy to sort of help provide for the next generation or multiple generations. Other individuals use 529 plans. These kind of tools can help control how those funds are ultimately used. Gifting can also preserve family harmony as long as it's done with transparency and planning. Your estate plan is more than just numbers, it's your life story. And gifting allows you to model your values, such as generosity, responsibility, or physical stewardship. So many families use gifting as a way to educate. They may require some sort of philanthropic effort that they're using the money for, so to encourage involvement in the community, or they may encourage goal setting. So if you're able to maximize out your 401k, I will give you X amount of dollars. Estate attorneys and advisors can help design plans that align with your intentions and your family dynamics. So lifetime gifting is really a way to sort of help put what you value on the money that you're passing to the next generation. So tax efficient giving strategies are 529 plan super funding. For 2025, there are some limits. You can use 5 years of the annual gift tax exclusion. So for 2025, that's $19,000, and you can give up to 5 times that. So for a single person, for one beneficiary, that is, you could put $95,000 into a 529 plan. Or if you are a married couple, you could do $190,000. The IRS does require that the 709 be filed with the 5-year gift tax election. The great thing about a 529 plan is the funds grow tax deferred and withdrawals are tax-free for qualified education expenses. It removes contributed amounts from taxable estate immediately, but it's also helping retain control over funds as they can only be used for education purposes. If there is no 529 plan, but maybe tuition or medical expenses are a part of someone's life and you want to give money to help assist with those, instead of just giving them the money to then turn around and use, you can make unlimited direct payments to another person's tuition or medical expenses, and it's not counted as a gift. The caveat is that you have to pay it directly to the institution. You can't give it to the individual. So this can help support the family without causing or reducing any gift or estate exemption. It's a great way for grandparents to help with private school or with long-term care expenses. Just another thing to think about is giving appreciated assets. If you give appreciated assets such as stocks, mutual funds, or real estate, you can avoid the capital gain tax on the appreciation. The recipient receives what's called a carryover basis. So the same basis that you had in the asset, the recipient receives it. This strategy would be ideal when the recipient is in a lower tax bracket or intends to hold the asset for a long time. This is something that you want to coordinate with your CPA or an advisor just to make sure that you're avoiding unintended tax consequences. Charitable gifting is something else that is a great thing to consider, and when you're considering gifting, it can reduce both your estate and income taxes by reducing your taxable estate, or can be used as a write-off for income. Look, it's important to coordinate with your attorney, to coordinate with your accountant, your advisor, just to make sure that you're not missing any steps. There's also some state-specific rules. There's deduction AGI limits. So it's really important to work with a professional on any charitable giving that you're doing. There are some types of methods to give besides giving just directly to a charity, which you certainly can do. And if you're giving to a charity or to any of these funds, it's recommended that you consider doing so with appreciated assets directly to these funds, trusts, or charitable organizations. One way that you could do charitable giving is through what's called a donor advised fund. What this does is this allows you to make a large charitable contribution now. You could likely use this in combination with some income tax planning. You would want to make sure that you're able to write it off. So if you're having a year where you're going to have a lot of write-offs, you're not going to be taking a standard deduction, you're going to be itemizing, consider doing a donor advised fund contribution because you can use it there. It provides that immediate tax reduction, and you're allowed to recommend grants to charities over time. This is beneficial in high income tax years as well. Contributions are irrevocable once assets are given to the donor advised fund, and they can only go to qualified charities. So how to best describe this is if you give $1,000 a year to a charitable organization, you can instead give one lump sum to a donor advised fund and then support that charity through annual contributions of $1,000 out of the donor advised fund. You get the tax benefit in the year that you make contribution to the donor advised fund, but it allows you to make distributions to your charitable organizations over time. A lot of clients also like the donor advised fund because it grows. There are some trust formations that you can consider, such as a charitable lead trust. These pay income to a charity for a set term. The remaining assets can then go to an heir. There is some tax benefit here as well, and it involves a calculation. So you'd have to work with your tax advisor, your advisor, and an attorney to kind of best figure out how to structure a charitable lead trust. Similar to a charitable lead trust is a charitable remainder trust. This can pay income to you now or to another non-charitable beneficiary, say a child, for life or for a set term. So you could have income from this trust being paid to a child for life or for 15 years. What's left of those assets then goes to charity. What this does is this removes assets from your estate. It provides some charitable deduction, and it helps spread capital gains out over time. These are both effective for diversifying highly appreciated or concentrated assets while also managing a tax impact. The Form 709 and gift reporting. The Form 709 is basically just a gift tax return. If you made a gift in 2025, you would just mention to your tax preparer that you made a gift, and they would make sure that your gift tax return or Form 709 is filed by the April 15th deadline in April of next year for a 2025 gift is how it would work. You have to file it if you give the annual exclusion to any one person, to a trust, or if you split gifts with a spouse. Even though tax is not owed, it's required to be filed, so the IRS is able to accurately record keep for your federal lifetime gift and estate tax exemption. Filing is also required for superfunding of 529s, or maybe some of the other advanced gifting techniques that we also discuss throughout this presentation. Some of the advanced gifting techniques, ways to think about these are interfamily loans. Very often, family members loan money to another family member, and the idea is that they can charge lower interest rates or no interest on, say, like a house that a family member is going to purchase. In doing this, you need to be careful because a lack of interest could cause a gift to be imputed if you do not apply an interest rate and sort of formalize the loan in a formal document at the applicable federal rate. And those are published each month by the IRS. So if you're loaning a family member any money, you need to be discussing this with your advisors, tax, wealth advisor, an attorney, and you just need to make sure it's properly structured. With intrafamily loans, one strategy could be you do the loan and then you forgive the interest every year and you just file a gift tax return. So that's just the more formal way to do it to make sure you don't get in trouble with the IRS. With blended families, or when there's a desire to have control over how the money is used, trusts are really important. And sometimes there's multiple, especially if they're stepchildren or just unequal gifting plans. And in these situations, gifting can be really powerful because it can reduce future conflict by making sure things are clear and intentional. And putting together a trust can really help with a blended family because a well structured trust can protect assets, it can honor legacy and wishes, and it can make sure that your intentions are well drafted and provides that level of control, which sometimes blended families have just a little bit more complex situations. If you're a high net worth individual or a business owner, here are some considerations that you should have. You can transfer family businesses, shares of a family business or an LLC earlier on. This can help reduce your estate value and can also start succession planning. Something you could consider gifting is non-voting shares to children. While you hold on to those voting shares, that growth is pulled out of your estate, reduces your estate, but it allows you to remain in control. When it comes to these types of scenarios, timing is really important. Having valuations are going to be really valuable in planning. It's going to be very important that you coordinate with a CPA or an attorney just to avoid any missteps or any sort of disputes. This is a strategy that you need to be thinking about well in advance before you actually make any sort of transition. And I will now proceed to the question and answers portion of our presentation. Please make sure that you enter your questions in the box below, and I will do my best to answer them.